All right, Mike, here we are again. We got we have an exciting program to talk about that we wanted to get out to you that, hey, some of you are thinking about the possibilities of maybe selling and maybe buying, and how does that work, and how do we time this, and how do we put this all together? So Mike, let's talk about it, but maybe let's start with maybe, hey, where the market's at today, just to kind of give a quick little overview here.
Yeah, and I think so, depending on where you're located, and to start off, right, we don't normally always just talk about loan programs because they're not usually the most exciting thing. But we thought this one was relevant, especially in today's market with what we're seeing. Right? If we look out in terms of indexes and things like that, like the most recent stats show that we are seeing anywhere from 5 to 7% appreciation from homes. And the reason being is, right, the same issue that we keep talking about, right? The lack of inventory and still having demand in the market, even though we have those elevated interest rates and have remained here for close to a year now, right? Close to that 6.5 to 7.5% kind of mark. So what we're seeing, and especially to start the year, is we were back to multiple offers, right? It is challenging, especially in the Southern California market. Now every market's going to have its own kind of appetite for what's going on out there, but Southern California, we are seeing multiple offers on that house that is really sought after, right? So when you do find that perfect house, well, chances are you're not the only person that sees it. And so this product is kind of one avenue to help you out if you are looking to sell a property and buy a new property, because sometimes that presents a challenge. Because you want to be the best offer for the seller. And when you have to sell a property, maybe that doesn't always put you in that top position when competing against cash or non-contingent offers. So that's kind of what we're seeing in today's market, even with kind of elevated interest rates.
Let's talk. And that very last couple words there are the big ones on everyone's mind, like these interest rates of today. And, everyone looks at this as, hey, this is a negative, but this can actually be a positive because it is keeping a lot of buyers out of the marketplace. So it is helping our buyers have a better opportunity at being successful in purchasing a new home. So, but let's talk about options for what are the options when you're looking to, hey, I want to sell my house, I want to buy a new home, and how do I make this timing work? Like, let's talk about a couple options. You have you could be a contingent buyer where you could go into the seller saying, hey, I would love to purchase your home, but hey, I've got this home that I live in now that I have to sell. And, and the seller is really not real active or anxious to accept that offer because they don't know your home. They don't know what that looks like. So that kind of puts you maybe a little disadvantage depending on what the seller is looking for. You also have the HELOC product where you could do an equity line of credit. And I think challenge comes with that. Like Mike and I deal with this a lot where it's like, now you got to qualify for house payment that you have now, house payment on the new property. Oh, and you got this equity line of credit. Well, you pulled out some of this equity, so you'd have this down payment. Now you're qualifying for 3 mortgages. So for a lot of our clients, that might be a challenge to be able to do that. So,
well, and I would say, and reference the line of credit video that we did as well, and it'll kind of help break down how that works in terms of payments and things like that as an alternative option.
And talk about and then there's another option, a bridge loan.
Yeah, well, first we wanted to talk about, right, like your qualifying contingent, right, in terms of you can do that, but sometimes the challenges for most people, right, is that we have seen massive appreciation over the last 3 to 5 years. So for a lot of people, right, their wealth is tied up in their property. And so when we go to do that, right, if you want to write a contingent offer without accessing the funds in your house, well, you're going to qualify with 2 mortgages. And sometimes that new mortgage on the new house is going to be a bigger mortgage because you only have a specific down payment, right? Maybe you have minimum funds and you're going to put 5% down on the new house. So now you're qualifying with not only just a new mortgage, but also a bigger mortgage because that money is tied up in the property. And now that could be an option for someone that has savings, gift funds. But again, everything that we look at in today's market, right, is based off of your debt to income ratio. So those monthly liabilities start to pile up when we're going to sell that property after closing. And We're not offsetting it with anything. So that presents kind of a struggle for most people to try and qualify for those two mortgages.
Right. So we have these challenges that we're talking about right now. And Mike, I'm going to use you as an example here because there's another challenge that comes into play for our buyers, and that is their families, like their families, and trying to figure out how to do this. We have a client right now that has 4 kids, and they're trying to get through this, and it's challenging. Mike, you have a brand new baby in your house, so if you guys were looking at trying to put this together right now with a brand new baby, that's challenging, and that's hard, how to make that work. So, and that's really where this program comes in, and it's called Knock, and it's a great program, and it's a program that we have at Loan Depot, and it's an awesome program to help kind of alleviate these handful of items that we're talking about, and hey, maybe relieve a little of the anxiety that comes along with, like, how do we put the timing of this together and with our family, and hey, can we qualify, and all of those. So the Knock program, it's a bridge loan like what we were talking about. But Mike, let's jump into that and maybe highlight that. And if you have questions on this, we want to be able to help you. So we're going to just kind of take a high elevation view of this. There's likely going to be questions, but let's jump into that real quick.
Yeah, all right. And always keep in mind, right, everyone's scenario is going to be slightly different. So utilize us as a resource after the fact, right? If we didn't kind of hit on what kind of you're looking for and not fitting your specific scenario. But ultimately, a bridge loan, right, allows you to access the money in your existing property without selling it. So, right, you're being able to utilize those funds as a down payment on a new property. Now, typically, a bridge loan comes at a very high cost. It's kind of almost like private money, right? Because someone is giving you access to that equity before, in terms of like a second mortgage on the property. But it comes at a high risk most of the time, and a very short-term loan. So for that lender, right, they're taking on that risk in a short period, and they need to make money. So usually you pay 10, 12, 15% as an interest rate with a couple of points in terms of upfront cost. So there's always something that comes along with that. Now, this program, kind of one of the highlights is that it allows you to access the equity in your property, but it allows you to access it not just for the down payment on the new house, but it also allows you to access it to pay down debt. So maybe we need to get rid of high interest credit cards, student loans, maybe things that you had planned to pay off after selling the property. Now we're able to do it up front, which helps you in qualifying for that new mortgage. So it has a couple of avenues of how to use the funds. Now there is a ceiling, right? There's a maximum of 50% of the new purchase price, up to a $500,000 bridge loan amount. So there are some ceilings, and you can't put more than 50% down on the new house, right? So it's not meant to access the equity in your current property and pay cash for the new property. That's not the purpose of the program. It allows you to access up to a certain amount, typically 75% of that fair market value of your property, when accounting for your first mortgage plus this new second mortgage on the property.
Yeah, and you can, so and part of the funds that you can pull out, like you're saying, you can use for debt consolidation. That helps with that, but you can also, hey, maybe there's some improvements you want to do to the property. Maybe there's some, hey, paint, or you want to do a couple things. It's not meant for, anything structural or anything like that, but hey, something, if you want to, just do some things to get the property ready, maybe some things that you wanted to do, you can get, a certain amount of those funds can go towards that as well. Just being able to make your home more marketable when you're putting it on the market. So you can use it for that. The program will also, it takes into account 6 months of your current mortgage payments on the house that you're in now. So it takes that into account. So you don't have to you're not making a double mortgage payment. We're not qualifying you with a double mortgage payment. You're only qualifying for that mortgage payment on the new property. And the bridge loan that Mike was referencing, where, hey, it comes with some high costs, where we were typically qualifying you with that. There's no bridge loan. We don't have to qualify for that type of product here. So we're really just qualifying you on the purchase price, or the purchase of that new property that you're buying. So it's a great opportunity to remove some of these things that we're talking about here and let this program, work for you in this market.
Yeah, and so we touched upon kind of the details of how to use those funds, but in terms of this program doesn't cut out your realtor, right? It's still
Oh
important
yeah.
to consult a realtor through this process, still important to consult a mortgage lender through this process because you're still securing a loan on the new property. Now, the way that it works and why it helps from a financing standpoint is that Knock, they're a company, right? They are giving you a cash offer on your property. You'll know that number up front as a worst case scenario, right? They will have that cash offer in place. And now when we look at what's called conventional guidelines, when you have a cash offer on your property with no financing contingencies, we're allowed to exclude your current mortgage payment because at the end of the day, we know worst case scenario that your property is going to be sold, albeit maybe not the best offer for the property, but it's going to be sold and the debt is going to be gone moving forward. So what this allows you to do is you have this cash offer as a worst case scenario, allows you to write a non-contingent offer on the new property because your property is going to be gone. Let's say you get your offer accepted. Well, now you still go through the normal process with your realtor to list your property. Because like we said, that cash offer is not going to be maybe the best offer. You still want to list your property and test the open market to get as much as you can for selling the property. And you now, right, you have, like Glenn touched upon, you have 6 months to sell your property. That's why 6 months of payments are wrapped into this bridge loan. So you're not paying a mortgage on that, you're not making a payment on that second mortgage while the property is listed, but you have that 6 months to sell it. And in today's market, specifically Southern California, right, most areas are not a challenge as long as we are kind of setting that expectation and price correctly from the get-go.
Well, and I think the key point that what you're talking about there, Mike, is that I want to bring out is just to emphasize it is that you can use us to do the financing. So we're helping you with the mortgage. We're doing the loan just like we did for you before. And you're using the realtor that you use to buy the house if you so choose to. So you can. We're going to connect you back with that agent. That agent's going to help you so that they can list that property when you are ready. So you have that 6 months to sell, like Mike said. You have 45 days to get the property ready so that you can put it on the market. So your home will sell, in that next 4.5 months. So you're not going to have to worry about this end all cash offer that is being offered. So
yeah, and important to touch, right? Everyone wants to know what's the catch. And right, there usually is a catch with programs. And right, there's going to be a catch with any of the options that we provided. So for this program, they do charge a fee of 2.25%, so 2.25% of the listing price. Now that's wrapped into that bridge loan, so it's paid up front. Right, so when you go to sell the property, there's not an additional amount. You're just paying off that first and second mortgage. So there is an upfront cost, right? And that's convenience, right? We have to kind of look at it from that standpoint, but maybe it doesn't work for everyone as well. We have to make sure that that cost makes sense for you in your scenario as you kind of go through this process. And like we talked about, there's always going to be a cost. It's just a matter of where it's going to be. Are you going to pay more for the new house because you are contingent? Right? There's that dynamic. Are you going to pay more in terms of fees on the line of credit and the interest that accrues on that over the life of the time you have that line of credit to help kind of bridge per se? We just have to be able to weigh these options to see what makes sense for you and your family, really from a stress standpoint and a comfort standpoint.
Well, I think you're talking about this negative and you're saying, hey, it is a negative, but turn it into a positive, just like interest rates today. So there's a lot of opportunities around this program. It might not be right for everyone, but we would love the opportunity to kind of go over this with you so that we can see if this might be a program that's right for you. It is definitely a great option for you, especially with all the things that we talked about, qualification, family, just timing and how to figure this out. This could be something that is very beneficial for you. And hey, stress and anxiety, that has a dollar amount as well, and that's worth something. So what is that worth to you? Let us help you figure that out. And we would love the opportunity to take a look at this with you. So Mike, I think that's it. Do you have anything else that before we wrap up here?
No, I think our leave behind would be, yes, reach out to Glenn or I. It's very easy to kind of get an initial calculation to figure out, okay, what's your house worth? What do you owe on it? To figure out, okay, how much access to equity do you have? And does that help your scenario?
Absolutely. So until the next one, thanks for joining us, and we can't wait to see you next time.
Have a good one.